Happening in the gone by week. Let's stay with that debate on big deals, and to tell us more about, in fact, give us a perspective on how they've been shaping up, how they are expected to shape up in the short term, and what's the view on the synergies that companies can derive from these acquisitions in the long term. We're joined by Mr. Bundeep Singh Rangar, Chairman of IndusView Advisors, in our Delhi studio link. Good afternoon, Bundeep. Thank you so much for joining us. Put it into perspective. How do you view these deals that are large in size and scale and potentially can be very, very beneficial for the companies which are making these acquisitions from a long-term perspective?
Hi, thanks. I think you hit it on the nail on the head when you said it's from a long-term perspective. These deals are not meant to provide a short-term increase in earnings per share, or for that matter, a great deal of shareholder value, because there's too much risk involved. There's a risk, one, of the price being paid. The valuations of the acquired companies are far in excess of those of the acquiring companies. And the biggest risk in an M&A deal is not the deal itself, it's the post-merger integration. And there's a lot of, still lack of experience by Indian companies. As ambitious as they are, they're not quite global as yet in integrating a large-size acquisition of the kinds that we've been seeing in the past few weeks. Now, having said that, if Indian companies want to go global, and they do want to hit the kind of scale you see from not just, the top companies in India, but globally the Fortune 100 companies, you have to buy that growth. I mean, Tata Steel could not have gone from 6 million tons of capacity to 25 without acquisition. So, or inorganic paths are the way to get that scale. And the long-term benefits, even mid-term benefits, will be there provided they can get the cost rationalizations, the synergies, the flow-through effect on the bottom line, and therefore a positive effect on the EPS.
So what you're trying to say is that going forward, it is mandatory for most companies to bid for, with the intention of breaking into the big league, they would have to make these kind of large-scale or big deals.
Yeah, I wouldn't quite go as far as saying as mandatory, but I think if someone has ambitions, clearly what Indian companies are going for, if you look at acquisitions worldwide, you're either buying new markets, new customers, you're buying high-end intellectual property of either process technology, product technology, patents of some kind. Most of the acquisitions we're seeing right now are for scale. They're for getting customer and global scale for companies that have largely been confined to the domestic market. So I think in that regard, it's, I won't say mandatory, but there's very few other paths. If you go organically, it takes a very long time. And if Indian companies can do this in a way without getting their debt to equity ratios too upset, and effectively being able to keep the pace of growth that they've had, which basically allows the free cash flow to come through and pay off the acquisition price over time, we'll see a positive effect on both the earnings and, of course, the share price.
Bundeep, we remember speaking to you at the time of the Tata Steel acquisition, and you were in London at that time. Could you explain to us whether the opportunity cost of the post-integration synergies 3, 4, 5 years down the line is indeed that much more than the short-term earnings dilution that the companies would have to stretch the gap that they have to pay for these companies in the case of Tata Steel from 455 to 608? Is that actually justified? Is that premium really justified by the spread and opportunity cost, you think?
If there's one company I would bet on being able to get the integration cost down, it would be Tata as a company. They've just been brilliant in execution pretty much so far. And even when people have discounted them, be it around the Tata Indica car launch, et cetera, they've shown time and time again, from acquisitions made in Korea to Tetley in the UK now 7 years ago, they've been able to get the cost synergy effect. And I think that's the key to the message here, that, yeah, they paid a premium price, probably very, very close to the top end of their desired price, if you may, or for that matter, allowed price for Chorus. But I think they have basically a recognition that the world's getting smaller, and if they want to be globally competitive, they've got to keep up with the likes of ArcelorMittal, where purchasing power on the one hand vis-a-vis suppliers, and market power on the other hand vis-a-vis having strong distribution, strong processing capabilities, and of course a very important brand is going to be important. And that's where the M&A story makes sense. If you want to get truly global, you've got to look at other values, such as your brand, such as the ability to serve a customer close to the point of need, and of course getting economies of scale. That's just not possible that easily organically.
That's exactly my question, Bundeep. Are these companies like the Hindalcos of the world actually paying for the benefits that they're actually going to get post-integration, or are they actually paying to compete at the highest level at any cost? Because the growth, of course, India is established as a low-cost producer, but is there indeed a case where these people might just be paying to actually become global competitive players at any cost versus actually, overpaying the kind of synergies that they may actually see 3-4 years hence?
Well, I think if you ask the Indian investor today, they'll probably take the view that they've paid too high a price. Hence, you've seen the share price declines in most of the companies that have been involved in M&A deals. It's really not for me to say if there's too high a price. I think the real answer lies, if I had a crystal ball, I'd look into the future and look down 3 years down the line and say, did Tata Steel get the $250 to $300 million cost savings they're talking about? That's a 3-year game plan. So it's in some ways a bet on the execution capability of the company to get those cost synergies, and which is why I said if anybody I'd bet on, it would be Tata as a company that's been very good at executing brilliantly. Now, it's definitely at the high end of any price, and that goes pretty much across the board, whether it's Aditya Birla's group or Tata, or for that matter, Vodafone coming into India or expanding its presence in India via the SR deal. But all those deals are critically dependent on what I said before. It's post-merger integration. If they can successfully do that, you've got the cost rationalization. But there's no one in the market who would say today that they've paid a cheap price. And that's part of the conundrum right now. If Indian companies want to buy companies on the cheap, you're looking at companies that are not hugely profitable, if profitable at all. So the result of that is you're not buying either a very healthy company, or by buying a less profitable company, you take an earnings per share dilution right up front. If you want to get a company that has a high profit and a high EPS, you're going to pay a premium price. And the effect of that can only be measured 3 years down the line. So that catch-22 is where Indian companies are. The good thing is they're not waiting to just get cheap companies and maybe turn them around. They're going after the big juicy targets to get global scale, and that's positive.
Truly trying to break into the big league. Bundeep, thank you so much for joining us and giving us a perspective on all the big deals that have been happening in the week gone by. In fact,